Hello everyone, this is Paris. Welcome to Budgetholics. In today's video, we're going to update the list of the best dividend stocks to buy now for January 2021. If you're interested in generating a stream of passive income, dividend stocks are the best way to achieve it. And if you want to learn more about dividend stocks, check out my video for which I'll leave a link here and down in the description. In today's video, we're going to update the December 2020 list because a lot has changed since then. And without further ado, let's jump into the 5 best dividend stocks to buy now. I'll be dollar cost averaging in all these companies throughout the month, but keep in mind this is based on my own research and you should always do your own research. Do not rely on my research, I'm just a random guy on the internet, I'm not a financial advisor, and this channel is for entertainment purposes only. Starting off at number 5, we've got Lowe's. Lowe's is the second largest home improvement retailer in the US, behind Home Depot. In fact, you can check out the Dividend Diplomats showdown between Lowe's and Home Depot. While lockdowns were imposed across the US, many of us chose to dedicate some time to improve our homes. However, a large number of home improvement retailers were brought down by the pandemic. Lowe's were able to leverage their strong e-commerce platform, not focusing on physical retail stores, thus achieving an increase in e-commerce sales of more than 100% in the third quarter of 2020. Along with Home Depot, they essentially have a duopoly of the market, and this makes them one of the most dependable companies you can currently hold. They have a price-to-earnings ratio of 23, which is right around the 15 to 20 most investors aim, and a payout ratio of 25.72%. Usually when you're looking into a dividend stock, you're looking for a payout ratio between 30 and 60%. The payout ratio is the percentage of the profits the company is distributing to its shareholders in the form of dividends. Lowe has a dividend growth rate of 9.22%, which they increased in August, and they've been increasing their dividend for 47 years, making them dividend aristocrats 3 years away from being crowned dividend kings. Their current dividend yield is 1.47%, which is admittedly low. However, they almost have a 2-digit growth rate, which in combination with the strong financials and fundamentals of the company makes it a good buy. The company is currently trading at $163 per share, which is well below most analysts' price target. Number 4 on the list is Realty Income, which is a real estate investment trust. Real estate investment trusts are a form of company that owns assets across the world, and they are obliged by law to pay their shareholders at least 90% of their profits in terms of dividends. Real estate is a sector that took a big hit during the pandemic, as private tenants had their incomes reduced and corporate tenants were not making any sales and thus were unable to pay rent themselves. On the plus side, Realty Income is renting its properties to established essentials retailers such as Walgreens, Home Depot, and Walmart. The income from those established brands allowed them to keep their dividend, and Realty Income stock only fell by 3% over 2020. They have a payout ratio of 197.61%, which might have been a red flag for other dividend stocks. However, extremely high payout ratios are very common in the case of REITs. They have a price-to-earnings ratio of 49.36 and a solid dividend yield of 4.68%. Moreover, their current dividend growth rate is 3.09%, and they're also dividend aristocrats as they've been increasing their dividend for 27 consecutive years. Realty Income is currently trading at $59.36 per share, which is well below the 68 target of most analysts. At number 3, we have Walgreens Boots Alliance, ticker symbol WBA, which is one of the largest pharmacy retailers in the world. They have 21,000 stores in 11 countries, and they came into existence after the Walgreens company, founded by Charles Walgreen in 1909, purchased the Swiss Boots Alliance in 2014. One of their subsidiaries is Boots the Chemist, which is the UK's largest pharmacy retail chain. Pharmaceuticals are on the rise and their largest distributor is sure to follow. Moreover, they're partnering with DoorDash to expedite deliveries and with VillageMD to place doctors in every Walgreens store. Pharmaceutical companies and large retailers are very recession resistant. However, WBA was one of the companies that were hit very hard by the pandemic. They had a huge loss of income, especially from their UK subsidiary, resulting in a payout ratio of 355%. This loss resulted in a huge accounting write-off. However, they were able to protect their dividend given the cash they had on the side. Their PE ratio is 8.3, which is the lowest in the list, and their current dividend yield is 4.35%. WBA's current dividend growth is a little bit over 3%, and they're also almost a dividend king as they've been increasing their dividend for 44 consecutive years. WBA is currently trading for $45.26, which is above the analyst's average price target of $42. At number 2, we have the world's largest telecommunications services company, which is AT&T, ticker symbol T. AT&T has 3 main divisions: AT&T Communications, which offer mobile and broadband services; Warner Media, which includes Warner Bros. And HBO; and AT&T Latin America, which services 11 countries. Although it is true that many of their technologies will be obsolete in the years to come, there are 2 main drivers for their growth. The first is the 5G network rollout across countries, and the second one is HBO Max. 5G is a technology that's expected to generate a lot of growth. AT&T, being the largest telecommunications provider, will surely profit from it. And in terms of HBO Max, AT&T has a ton of content available for customers to watch, both from HBO as well as from Warner Brothers Productions. Their current payout ratio is 65%, which is just a bit over the 30 to 60 range we're usually aiming at, and they have a PE ratio of 18.97%, which is close to the fair value of 15 to 20. Their current dividend yield is 6.97%, and their current dividend growth rate is 1.97%. They've been growing their dividend for 37 consecutive years, which also makes them a dividend aristocrat.
AT&T is currently trading for less than $30 per share. This is due to the fact that it took on huge debt to finance 2 deals. The first one was the purchase of DirecTV in 2015 for $48.5 billion, while the second one was the deal with Time Warner in 2018. The purchase of DirecTV was obviously a mistake, as they've lost close to 1/3 of the customers. However, the deal with Warner Media appears to have some potentials due to the fact that they were able to create their HBO Max service, competing directly with Netflix, Amazon Prime, and Apple TV. Analysts have a price target of $31 per share, so the consensus right now is to buy.
And in number 1, we have the world's largest company in terms of market cap, Apple. Apple is a tech giant. Their iPhone was a huge success. Apple customers have one of the highest brand loyalty out there, and many of them are expected to upgrade to the new iPhones utilizing the new 5G technology. The M1 chip was also a great surprise for Mac users, and more computers running the M1 chip are expected to come out in 2021. Moreover, they have a very strong ecosystem of services. iTunes revolutionized the music industry, and along with News, Arcade, Apple TV, Apple Card, and other services, they have built a very strong network users can use either individually or with their families. Finally, the Apple Card news that came out in November also contributed to the hype of the company. And last but not least, Apple is not only a great dividend stock, but it's also a great growth company. It was the second best performing company of my portfolio, and if you want to check out the full list, you can do so using the link here or down in the description. In terms of financials, they have a payout ratio of 24.24% and a PE ratio of 40.14. Their current dividend yield is at 0.63% with a dividend growth rate of 6.25%, which they've been growing for 7 consecutive years. Apple has lots of cash on the side, which makes it one of the safest, if not the safest, companies in terms of dividends. And they are run by a management team whose interests align with those of their shareholders.
After experiencing an 80% return over 2020, Apple is currently trading at $132, with analysts' average price target of $129. Apple is still a buy.
This was my list of the 5 best dividend stocks to buy now in January 2021. Let me know what are your thoughts on these companies and what are your best dividend companies to buy right now. Also, if you enjoyed the video, please hit the like and subscribe button and share it with anyone you think might find it useful. Until we meet again, don't stop investing.